Howdy, everybody. Welcome to Liberty Call. Today is Friday, September 20th, 2024. Hope you're having a great day out there. It's another nice day here in Colorado. A few clouds in the sky. It's a little warmer than yesterday, but we got a cool front coming through. Awesome. All right. Well, hope you're, like I said, hope you're having a good day. And before we jump into the markets and the numbers and the economic data that all came out this week, I need you, yes, you, to do me a favor. Give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All right, let's go ahead and jump into today's markets. Dow Jones was flat, up 0.09, 38 points, closed at 42,063. S&P 500 down 0.19%, 11 points, closed at 5702. NASDAQ down 0.35%, 62 points, closed at 17,951. VIX down 1.1% today. It's at 1615. Canada flat, up 0.01. Brazil down 1.5%. And Mexico down 1.33%. In Europe, more ugliness. Germany was down 1.49%. The UK down 1.19%. France down 1.51%. Netherlands down 1.2%. Spain down 0.21%. Italy down 0.83%. Switzerland down 1.04%. And Portugal down 0.06%. So a lot of red across Western Europe. Russian exchange is in the green. MOEX up 0.88, RTSI up 1% flat. And the Asian markets, they were a little happier. The Nikkei was up 1.67%, Australia up 0.21%, New Zealand down 1.41%. In China, the Shanghai was up 0.03%, the Shenzhen Component down 0.15%, China A50 up 0.2%, DJ Shanghai up 0.1%, Hang Seng up 1.36%. And the Taiwan weighted when it closed on the 19th was up 1.68. All right, so those are the markets. Let's hop into the weekly returns or weekly returns for the markets here. Let's start now with the Dow Jones. Looks like it's going to finish the week off up about 1.59%. S&P 500, where's that candlestick right there? Going to finish the week off about 1.55% up. The NASDAQ up about 1.57%. So we're all kind of in that 1.5 range. The Dow Utilities looks like it's going to be in the red by about 0.35%. And the Dow Transports barely in the green, up 0.12. So the major indexes were all about 1.5, and then those two intermediate indexes were much more muted. So, all right. So those are the markets for today. Let's put my chart stuff back so when I come back Monday, I know what I'm looking at. All righty. Well, let's get into the economic data that came out this week, starting out with jobless claims. Initial claims came in at 219,000, forecast 230. Previous number was 231. Continuing claims came in at 1.829 million. Forecast was 1.85 million. Previous number 1.843. So down by about, about 14,000. The New York Empire State Manufacturing Index came in at 11.5. Forecast was negative 4.1. Previous number was a negative 4.7. So hopped back into the positive for the first time since, when was this? November of last year. So, but again, if you look back historically, really since about 2020, late 21, the end of 21, we've had more negative results than we've seen positive. All right. Retail sales year over year was up 2.13%. Previous number was 2.86. On a month-on-month number, retail sales grew by 0.1%. Forecast was a 0.2% contraction. Previous number was a 1.1. Industrial production year over year grew at 0.04%. Previous number was 0.74, a contraction of 0.74%. And on a month-on-month grew by 0.8%. Forecast was 0.2. Last month's number was a contraction of 0.9. Housing starts came in at 1.356 million. Forecast was 1.310 million, so about 46 over. Previous number was 1.237 million. And building permits came in at 1.475 million. Forecast was 1.41, and the previous number was 1.406. And let's see, we got a couple more things here. Existing home sales came in at 3.86 million. The forecast was 3.92. So we can see it's been, kind of trickling down this way since, what was that, March, the March report, because it jumped up from February to March and then has started trending down again. And then last, existing home sales month over month contracted at 2.5%. All right, so that is all the economic data that is fit to be told. Let's hop into the market recap. U.S. stocks slip as investors weigh FedEx slump and Fed outlook. U.S. stocks were slightly down on Friday as investors evaluated the impact of FedEx's poor earnings and speculated on further Federal Reserve rate cuts. Earlier in the week, the Fed initiated a rate-cutting cycle with a significant 50 basis point reduction, sparking optimism. Yay! The enthusiasm had driven both the Dow Jones and S&P 500 to record highs on Thursday. Despite Friday's losses, all major indices are on track for weekly gains. The S&P 500 up 1.6, Dow Jones up 1.5, and the NASDAQ in the lead at 1.9. Well, this article is a little dated because we know that it came back down a little bit. Analysts noted that historically stocks tend to perform well during Fed rate cuts when the economy continues growing. Well, if it continues to grow. Concerns from early August prompted by weak U.S. job data seem to have faded as market anticipates further rate cuts. Fed speakers, including Philadelphia Fed President Patrick Harker and Governor Michelle Bowman, returned to public discourse following the Fed's blackout period. Bowman, the only dissenting voice against the 50 basis point cut, favored a smaller 25 basis point cut to avoid the impression that the Fed had conquered inflation. FedEx dropped nearly 14% after reporting disappointing earnings, signaling potential economic weakness. In contrast, Nike surged 6% following the announcement of CEO John Donahoe's departure, with his replacement expected to revitalize the company. Well, who's his replacement? It's not mentioned here. American Airlines also made headlines, reportedly in talks with Citigroup to replace Barclays as its credit card partner. Well, there you go. Citi's not a bad company. I worked for them for, 5 years, maybe? Anyways. All right, next up, got an article from Zero Hedge. It's titled Market Declines and the Problem of Time. And this was written by Lance Roberts via realinvestmentadvice.com. So let's see what he has to say. Lance Roberts argues that while stock markets rise more frequently than they fall, investors often overlook the impact of market declines, primarily due to misunderstandings about math and time. The common belief is that bull markets significantly outweigh bear market losses, but this ignores key factors, especially the role of time in investing. While stock markets may average, and that's in quotes, an 8% annual return since 1900, real-world results for most investors who typically start saving seriously in their 40s differ drastically due to market corrections. Market declines can severely impact long-term returns, and recovering from a significant drop can take years, eating into growth of investments. Yeah, I mean, those of us who've had our adult years through the dot-com bust back at the beginning of the century, the housing crisis in 2008 and 9, and then, the COVID nonsense 4 years ago, and then, the repercussions from that we've been dealing with ever since. So, yeah, I mean, a 50-year-old guy like myself who, went into the workforce in the, in the mid-90s, we've had nothing but chaos every, 5 to 10 years. So, I mean, again, we're the latchkey generation who had terrible parents, so nothing really bothers us too much. Alrighty, where was I? Roberts emphasizes that time and valuations are crucial factors for investors, particularly as markets often go through extended periods of near zero or negative inflation-adjusted returns, especially after high valuations. The problem with percentage-based returns is that a significant correction, such as a 50% drop, can erase much of prior gains, complicating recovery. Investors' reliance on average returns often leads to disappointment, as the actual returns frequently fall short of expectations due to market downturns. Roberts concludes that focusing on risk management and adjusting expectations for future returns, particularly during high market valuations, is essential. Active strategies to preserve capital rather than relying solely on long-term average returns can help investors avoid severe setbacks, particularly as they approach retirement. Well, I know what I did, during the the housing crisis was, for basically, all my clients, I typically you fall within from, conservative to aggressive, and there's 5 risk tolerances, across that spectrum. And, so if you were like, say, moderate aggressive, we just moved you back 1 or 2 so that, as we were heading into, I guess, 2008 when things started really to slide, we could see that the yield curve was inverted. There were a lot of problems on the, that were, flashing red lights at us. Hey, there's a problem in front of us. And so, granted, I didn't have a lot of, experience at the time, but I was listening to the smart people around me, and, that's what I did. And, it worked out fairly well. I mean, not to say, no one didn't have losses, because that, that was basically impossible if you were invested in the market. But, is it better to lose 10% or 40%? Which is easier to recover from? So, it's that sort of thing, adjusting your risk tolerance based upon what you think is in front of you. And that's really where I got kicked in the nuts in 2020, was that, my expectation was we were headed into a bear market. I had no idea that the whole COVID nonsense was going to give an excuse for the Fed and the government to print all that money. And then we have all this inflation, which makes everything look like it's fine, which it's not. If you look at prices in respect to, say gold or silver, everything is more expensive today. But anyways, all right. So I guess my advice is be careful out there. And, if things seem too good to be true, which is what it was like in 2006 and 7, you probably want to adjust your risk profile a little more conservative at that time. All right, one more article comes from our buddies over at the Mises Institute. The Fed hits the panic button and slashes the Fed funds rate. This was authored by Ryan McMacken, very smart guy. The Federal Reserve's Federal Open Market Committee, the FOMC, made a significant move by cutting the federal funds rate by 0.5% from 5.5% to 5%, marking the largest cut since the COVID-19 crisis in March of 2020. The decision comes after 14 months of maintaining a rate at a 20-year high, with the Fed previously raising rates to combat inflation, which peaked out at 8.9% in June of 22. Despite Fed Chair Jerome Powell's optimistic statements during the press conference, claiming that the U.S. economy and the labor market are in great shape, that's in quotes, the size of the cut suggests otherwise. Historically, such large rate cuts are made in response to significant economic challenges, usually preceding recessions by a few months. Notably, similar cuts occurred before major downturns in the late 80s, 2001, and the Great Recession of 2007. The August Beige Book, which provides economic reports from Federal Reserve districts, further indicated a weakening economy, with only 3 districts reporting modest growth and others showing contraction or stagnation. Although Powell attempted to downplay the concerns, the timing of the cut just weeks before the national election, well, it's a federal election. The United States is not a nation, people. Raises questions about whether the decision was politically motivated. No, never. Well, just like when Fed Chair Powell back in the fall of 2019 started lowering rates again, at I imagine, the behest of the Trump administration, because they had an election coming up and they didn't want, because they were raising rates at the time because they've been held at 0 since the beginning of the Obama years. And it started having negative effects. You had the reverse repos and, how the money is moved around behind the scenes of the banks. Those the repo rates were going through the roof. So there was a lot of uneasiness in the in the markets behind the scenes. The regular people, they didn't really have a clue. All right, where was I? The Fed seems to be prioritizing preventing job losses over controlling inflation, as the rate cut is inflationary. Ultimately, the Fed's move may signal a more fragile economy than Powell acknowledged, and skepticism about the Fed's optimism persists. All right, so we'll see. If it holds true to form, we'll head into recession here, probably after the election. Awesome timing. Way to go. I mean, not that I care either way. Whoever gets elected, which will lead to the end of the republic sooner, that's who I'm leaning towards. So if if Kamala, if that makes the Republicans get so mad that they finally say, screw it, we're done, I'm with them. If, or I'm with that. And if it's, Trump makes the left say, you know what, we don't want to be part of y'all anymore. Yes, thank you very much. But I have very little confidence that's going to happen. There's just not enough mad Americans out there. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. That's where all your financial planning needs can be addressed. So give me a buzz. I'd be happy to help. All right, well, like I said, that's everything I have for today. And I hope everyone out there has a wonderful weekend. Got college football, got baseball, pro football, got everything you could want to watch. Plus, the weather's probably nice. I mean, maybe not down in Houston where a lot of my friends and family are at, but, you're used to sweating your balls off. So, all right, well, hope everyone has a great weekend, and I'll talk to you next time. Adios.